Hi, I'm Anna and welcome back to my channel, Building a Business.
So in today's video, I'm going to be going over a few different options of paying down your mortgage early and why the different options may appeal to you or not. So first, this is just a general mortgage amortization schedule. So I just assumed your loan amount was $100,000, the loan term was 30 years, the interest rate is 0.035 or 3.5%. And your monthly payment would then be $449. So that monthly payment is calculated using this equation, and in this case, M is equal to the monthly mortgage payment. So that's the $449 that I calculated. P is equal to the starting loan, so in this case, that's $100,000. I is your monthly interest rate. Now it's important to note that it says monthly here, and so the interest rate that I said, 3.5%, that's the annual interest rate. So you'll have to divide that by 12 to get the monthly interest rate. N is the loan length in months. Again, keyword months. So our loan is for 30 years, which means you'll have to multiply that by 12 to get it into months, which comes out to 360 months. Now, if we go back to the Excel, so we've now just explained how you calculate your monthly payment. Now let's start doing the amortization. So in the very first year, the month that you purchase the property, your balance on your mortgage is $100,000. I put the equity as 0 because I'm not sure how much the down payment was. This is just an example. And so this equity listed here is the added equity, which means your total equity in the property is whatever you put as a down payment. For instance, say $20,000 plus whatever value you have here. So your equity in month 6 would be $20,000 plus $951, or just $20,951. Now each month you're going to pay $449 towards your mortgage. Some amount of that $449 will go towards interest, and the rest will go towards paying down your principal. Now to figure out how much is going towards interest, you simply take the interest rate, divide it by 12 to get your monthly interest rate, and then multiply by the loan balance of the previous month. So for the very first month that we're paying for our mortgage, the balance the previous month was the full mortgage, or $100,000. So you take 3.5%, divide by 12, and multiply by $100,000. Now that equation is the same all the way down. So your interest rate stays the same every single month, but the balance will be continuously decreasing, which means that the amount of your mortgage payment that goes towards your interest will decrease each month. Now to calculate your principal, it's pretty simple. You just take your monthly payment and you subtract how much you paid towards interest. Then the rest will go towards your principal. To calculate what the balance is at the end of the month, you just take the balance from the previous month and subtract the amount that you're paid towards your principal. Similarly, your equity is equal to the equity you had the month before plus the amount you paid down on your principal. So if we scroll down, what you'll notice is the amount you're paying towards interest is decreasing, the amount you're paying towards your principal is increasing, the amount left on your mortgage is decreasing, and the amount of equity you have is increasing. If we go all the way down, you'll see that because we have a 30-year loan, you should pay off your full mortgage at the end of year 30. And sure enough, the last month, you have $448 remaining on your mortgage. You'll remember that the monthly mortgage payment is $449 per month. So with our calculation, you pay $1 towards interest and the rest towards your mortgage, which is equal to your mortgage, and therefore at the end of the last month of the 30th year, you have paid off your mortgage. So that's great, but 30 years is a long time. Maybe you've decided that you want to pay down your mortgages early. There are a few different ways to do this. One way that's fairly common is to break the year up into weeks instead of months. Now each month is a little bit more than 4 weeks, and so instead of paying your monthly payment 12 times per year, what you could do is take your monthly payment, divide it by 2, and then pay it every other week. If you do that, then by the end of the year, you will have made 26 half payments, which is equivalent to 13 full payments. Essentially, you've paid 1 extra month on your mortgage each year. So to represent that, I just said that you made an extra principal payment once a year on the very last month. And this principal payment goes directly towards paying down your balance. So none of this goes towards interest. Now, this isn't exactly how people would do it. In general, people who follow this plan will actually pay half payments every 2 weeks, meaning that they have smaller payments throughout the year, but for simplicity's sake, I just lumped it all at the end of the year. And what you see if you scroll down is that you end up paying off your mortgage significantly earlier than you would otherwise. So here we have in year 27, at the end of the third month of year 27, we have $49 remaining on our mortgage. And so we pay that $49 and then we have completely paid off our mortgage. Now, this is certainly nice to pay off your mortgage early, but in the scheme of things, paying off your mortgage 3 years early when your mortgage is 30 years long probably doesn't make you too excited. So let's go for a different option. So in this case, what I'm showing is taking all of your income from the rental property and using it to pay down your mortgage faster. So in this instance, I assume that your cash flow each month on average would be $150. So every month I added an extra principal payment of $150. If you scroll down, you can see that you fully pay off your mortgage at the beginning of year 20. Now, that's a huge difference in my opinion. 20 years versus 30 years is a lot. Of course, it is still 20 years, so you would probably want to use that $150 per month towards purchasing another property or saving in some other way, but you could use it to pay off your mortgage. Now, a lot of people would argue that paying extra each month on your mortgage doesn't make sense. And the reasoning behind that is because let's say your mortgage is $500 per month, and every month you pay the $500 plus an additional $500. So essentially you're paying double what you need to each month. Then let's say one month, for whatever reason, you can't get a hold of $500. Even though you've been paying extra for many months, that extra doesn't count in your current month. So these extra principal payments that you're using don't count as prepayments. You can't then later come back and say, well, I paid $500 extra 2 months ago and use that as your payment for this month. So what a lot of people will do, even if they've decided they for sure want to focus on paying off their mortgage, is that instead of paying this extra money, they'll save the money on the side. And then once the amount of money that they have saved on the side is bigger than the loan balance, then they'll just pay off the mortgage in full. And the reason that I think this is a better idea is, one, you have that extra money sitting on the side so that should there be an extreme expense or anything else that comes up, that money is waiting for you and ready. And the second reason is it will take you a while to save up enough to pay off your mortgage. And so while you're building up enough money to pay off your mortgage, you may decide that that's not actually what you want to do. You may instead decide to purchase a new property or invest that money in some other way or make some other sort of major purchase. And so it's nice to have that money on the side as added flexibility and security. So just to show you what that looks like, in this example, I'm saving the money that I make through cash flow on the side, but I'm not putting it towards my extra principal payment. Once I get down all the way to year 22, once I get down here, you'll see I have enough money to fully pay off my mortgage, and so that's what I do. I've just explained that I think this is the smarter way to do it. However, you will notice that if you do it this way, you pay off your mortgage towards the end of year 22 instead of at the beginning of year 20. So you just have to know that if you do it this way, it will take you longer to pay off your mortgage, but it gives you so much extra flexibility and security that in my mind, I think it's worth it. Now let's look at one more hypothetical scenario. In this case, we're going to assume that you have 5 mortgages and you get each mortgage at the beginning of the next year. So you purchase your first property with a mortgage. Then at the end of that first year, you purchase your second property with a mortgage. At the end of that year, you purchase your next property, and so on. In addition to that assumption, I'm assuming that all of the mortgages have the same loan amount of $100,000 and the same loan terms in terms of 30 years at 3.5% with a monthly payment of $449. So at the beginning, you have one mortgage, and I'm saying that you're not paying any extra principal payment. Instead, all of the money you're cash flowing, you're putting on the side to save as reserve funds for when you purchase your next property. So there's no extra cash payments, but then at the end of the first year, you buy your second property. Then at the end of that year, you buy your third property, then your fourth, and then your fifth. Now, once you've purchased your 5th property, you have built up enough cash reserves that you decide to start paying off your very first property. So if we go over here, you'll see that I'm putting an extra payment of $750 per month towards your first mortgage. Now, the way I got $750 was taking the $150 that I cash flow per property and multiplying it by the 5 properties I have. So this is the beginning of year 5. If we scroll down, you'll see I pay off this mortgage towards the beginning of year 12. Now, everything starts speeding up because then with our second mortgage that we start paying off, we now have $750 like we had with mortgage 1, but we also add $449 per month because you've fully paid off your first mortgage, which means the monthly amount that you were paying towards that mortgage, or $449, is now being paid instead towards paying off your second mortgage. So now we're in year 11 and we are fully paid off in year 15. Now moving on to the third mortgage. For this first month, I have the $1,199 because I didn't use any of that money to pay off this mortgage in that month since I just had a little bit left to pay there. But then the next month, I have $750 plus $449 times 2 because now I have 2 properties paid off and so 2 less mortgages to pay for. We scroll down and that's paid off in year 17. Now when I say year 17, I mean year 17 for this mortgage, which is year 18 for this mortgage and year 19 for the first mortgage, essentially 19 years since you started. Now we've moved on to mortgage 4, and you can see again the lower amount towards paying off your mortgage, but then you quickly jump up to $750 plus 3 times 449. We've scrolled down and we've paid off our mortgage in year 18. Moving over, we now have $750 plus 4 times $449. So we are paying $2,546 per month to pay off this mortgage. We start that in the middle of this mortgage's 17th year, and we've fully paid off that mortgage in just about a year and a half. So that's pretty exciting because now you've paid off all 5 of your mortgages, and the rent that you would be getting each month is now $150 times 5 plus $449 times 5, or $2,995, basically $3,000 per month. Now, of course, this $3,000 per month isn't an exact amount. It'll vary depending on when you have vacancies and when you have to pay for repairs and maintenance and capital expenditures. But on average, given the assumptions I made in this Excel, you would be getting about $3,000 per year. And of course, why stop there? With that $3,000 per month, you can easily save up very quickly to purchase more and more properties and continue with your rental property business. So that's just a little overview of a couple different ways to pay off your mortgages earlier and some of the pros and cons of the different ways.
Thank you so much for watching. I hope you enjoyed my video, and if you did, please like it below and subscribe to follow along on my journey.